So as we continue on here, excuse me guys, so we are going to see that there are 3 ways in which we can determine the various values of what we're purchasing. There's one thing that's called a market approach, where it estimates fair values, basically using market transactions from other sources, similar types of assets but other sources. We can use one method called the income approach, where we basically look at various estimates of what they're bringing in, and we calculate some type of future cash flows based on the assets. Or we can do a cost approach, basically looking at the fair value of what it would cost for us to replace an asset. Now, acquisition method is the manner in which we're going to create these consolidated financial statements. If the consideration that an acquirer pays for a company does not equal the fair value of the assets, oh no, what are we going to do? Well, there are instances where the consideration is greater than the fair value of the assets, and in that case, the difference between what we're transferring in consideration to what we're receiving, we will show a goodwill as an asset on our books. But if the consideration is under the fair value of the assets, then we've got a deal. And this deal needs to be recorded right away as a gain. So we're going to still need to show the assets on the book at fair value. Okay? And the difference is going to be a gain from purchasing at a bargain purchase price. So, how do we consolidate the financial statements? We're going to figure out all the fair value of what was transferred and look at the fair value and apply them to specific assets within the company that's being transferred. And then we're going to basically follow various methods when we are consolidating financial statements when one company totally is dissolved. We're going to use a specific method to show on the financial statements how we consolidate all the assets into one company. But when we acquire a company but yet they are still operating independently, we've got 2 sets of books we need to consolidate. And so we have a different method in how we manage to consolidate 2 companies still operating, but how do we show it as one set of financial statements? So we're going to look at those. So here's an example. When one company purchases another and the company that was consolidated dissolves, it's no longer in existence. It gets just, the assets flow into the new acquirer's company. What we're going to do is we're going to figure out, what did we purchase this company for? Consideration, the amount paid. Then we're going to determine the fair value of various assets. In this example, we have a situation where we purchased this company at 20,000 shares and we paid $2 million for these 20,000 shares. We're going to, and we also, I believe, paid cash of $550,000 along with, and we acquired their notes payable. So in this case, what we've done is we're going to show the issuance of common stock for $20,000. We always keep the par value separate from the paid-in capital. You know what I'm talking about there? We paid $2 million for 20,000 shares, but we show common stock as just the par value of the stock, and then any amount we paid above and beyond goes into additional paid-in capital. Then we show the amount we paid in cash, $550. Then we show the fair value of the various assets and liabilities. So as you can see here, everything works perfect. We've got assets, current assets of $300,000, computers and equipment of $600,000, software $1.2 million, customer contracts $700,000, and we assumed a note of $250,000. So what we purchased it for basically equals the fair value of the assets we received minus any loan liabilities. But what if the consideration we paid is going to be greater than the assets fair value? So if you look here, we show here that we purchased this small port company. We purchased it for $2 million in stock plus $1 million in cash. Okay? So it's up $500,000 from what was previously shown. Then what we're going to do, we're going to show the assets at fair value. We're going to show minus the notes that are the liabilities we assumed at fair value. But can you see here now we have an added account on our books called goodwill? Because all we can do is show on our financial statement or in our transactions the fair value of these assets. If we've paid more than the fair value, we've got to come up with why we did, which is generally the intangible asset of goodwill. So when consideration is greater than the assets transferred, we're going to end up with an account called goodwill on our books. Here's an example of we paid less than the fair value of the assets. Here we paid $2 million, no cash, just $2 million of stock on purchasing this company. So we show the fair value of all these assets. We take into account minus the note we assumed. But when all equals, the fair value of the assets is a lot more than what we paid for the company. So we have, upon the acquisition of the company, we have to report a gain on our books right away. We can't show those assets at less than fair value. We need to still show those assets at fair value, but upon purchase of this company, we have a gain. Okay? So basically, if you get a multiple choice that says, what happens when consideration transferred is greater than the fair value of the net assets? The right answer would be goodwill will exist. But if your question is, what happens if consideration that is given is less than the fair value of the assets? What will be the correct answer? You have a bargain purchase gain, don't you? And you're going to have to show that gain on the books. Any questions so far? How's everyone doing? Okay. Now, how do we do this? You know those lovely worksheets we're familiar with since Accounting 1, Principles 1? Just a little bit more complicated of a worksheet we're going to use to consolidate these. How's the process happen? The parent prepares an allocation of the acquisition fair value similar to the equity method, and we're going to take the information of the parent and the sub. We're going to show it on the worksheet, and from there we're going to get rid of the subsidiaries' equity accounts. We're going to remove the investment in the subsidiary account on the parent's books. Then we're going to make sure the values, the fair values of the subsidiary get posted, and anything extra goes to goodwill. Then after that, we're going to take the various accounts and combine them. So we're going to combine the parents, the subs, into a new balance. And then finally, any expenses we incur to consolidate, we get to expense out in the current period and arrive at net income. Sounds easy, doesn't it? But sometimes we've got some other issues we're going to look at. When we recognize an intangible asset that's not goodwill, we need to determine how we recognize it. Does the intangible asset arrive from a contractual or other legal right? And is the intangible asset capable of being sold or separated from the acquired business? So if on the books of the company we're buying, there is an intangible asset sitting there, we need to determine, do we need to keep that on the books? And the two guidelines for keeping that on the books is the intangible asset arise from other legal rights, or can it be sold on its own? In that case, we're going to keep it on the books. For purposes of goodwill, if we purchase a company that has goodwill on their books, we're going to wipe that out and create our own goodwill. We're not going to continue that on the books when we consolidate. There are other methods. We no longer can use these methods, but again, you know that word familiarity? You want to be familiar with other methods that have been used in the past. The two methods that have been used in the past, now we just use the acquisition method. There is a method called the purchase method and the pooling of interest methods. But any combination that's happened after 2009, we have to use the acquisition method. For these combinations that happened prior to 2009, they're using a different method. So under the purchase method, the total cost got allocated to the net assets with anything else going to goodwill. But the valuation basis was cost, not fair value. So basically, the value of the consideration transferred plus direct costs related to the acquisition, we ignored any indirect costs and ignored any contingent payments. Basically, in this purchase method, the bargain purchase occurred when the sum of the individual fair values exceeded the purchase cost. That makes sense. Under pooling of interest, this happened up until 2002. It's not used anymore unless those combinations are still in existence. They would be accounted for under something called the pooling method when one company acquired all of the company's stock using its own stock and didn't have any cash involved. So basically, you took each person's book values and you combined them. So you just kept everything at book value. Basically, the revenues and expense accounts were combined. Everything was at book. So what I want to do now, in a nutshell, we went through everything really fast. Now what I